Hey everyone, welcome to the channel. My name is Eric. Today I'm going to talk a little bit about what it means to play the market or index the market, what investments might be a good fit for that strategy if they're good investments, and how you might buy them. I'll also show you some real-world examples of holdings that I have in my personal portfolio that would fit this strategy. So what does it mean to play the market or to index the market? It means that you are going to play the market as a whole. You are going to buy into an investment like a mutual fund or an ETF that holds hundreds of individual companies rather than try to pick and choose these on your own in an effort to beat the market as a whole. So this is a really good strategy. So if you look at active funds, so where there is a fund manager that's trying to outperform an index. Index can be grouped by things like sector. So maybe it's energy, oil, gas, things like that, or it could be just simply by the size of the company. And those are the ones that we will look at today. So let's look at three very common indexes. The first one is the Dow Jones Industrial Average. I'm sure you've heard of the Dow. It's comprised of 30 of the biggest companies in America. Think about companies like Procter & Gamble, Coca-Cola, Microsoft, Amazon, companies that size, huge, the biggest ones that are out there. The NASDAQ is another index. This one just tracks a lot more technology companies. So some of these are going to be common to the first one, the Dow. So again, think companies like NVIDIA, Microsoft, Apple, Broadcom, Google. All the big tech companies are going to be found in the NASDAQ. The next one is probably the most common, and that's the S&P 500, the Standard & Poor's 500 index. So this is America's biggest 500 companies, no other criteria. From 1 to 500 in order, it is just the biggest 500 companies in America. The next one is the S&P 500 index. Every broker out there will offer some variety of this. It is just the biggest 500 companies in America. Rather than try to, again, pick individual stocks, you're going to buy one investment product, a mutual fund or an ETF that contains these 500 companies, and you are betting that that is going to perform better than you trying to pick individual stocks. 42, and when I was younger, I tried to play individual stocks to varying degrees of success, usually varying degrees of failure. And over time, I learned that, again, you can't expect to beat a fund manager that has billions in the portfolio. They're Ivy League educated. How on earth do you think you're going to beat them when they can't beat the market, right? 85, 90% of the time, if you look, they cannot beat the index that they are tracking against. So people, again, that are Ivy League educated, have billions of dollars, have resources beyond anything that we'll ever have in our lifetime, can't beat the market. Really unlikely that you're going to find some loophole or some undervalued stock that professionals haven't already found and are probably already exploiting, right? So for people that are working to build wealth over time, this is what's worked really well for me. It's buying index funds, holding them for long periods of time, and letting them compound and grow over and over and over again. The most key point here is that you should buy them, hold them, and never sell. Let's take a look at a few mutual funds and ETFs that could be a good fit for you if you're looking to use an index strategy. So the first one up is something that I have held for ages and ages and ages, and that is the Fidelity 500 Index Fund. The ticker for this one is FXAIX. This is a fund that's been around for a long time. It tracks, again, the top 500 companies in the US. So when you buy this, you are quite literally buying small shares of ownership in over 500 companies. Over the last 10 years, on average, it's returned 14.59% every year. And these are some of the holdings that you are going to own when you buy a share of this mutual fund. Things like NVIDIA, Microsoft, Apple, Amazon, Meta, Google, Broadcom, all big companies in the US out there making money for you. The share price, $231. If you're a little bit worried, I can't afford to spend $230 to buy a single share of this, don't worry, you can actually buy fractional shares. So even if you only have 25 bucks or whatever it is you can afford every couple of weeks when you get paid, I guess I would strongly encourage you to do that. Something is better than nothing, and over time it's going to compound and add up to numbers that you really wouldn't think were possible. It does take time, but I am living proof that it works. Quick look on how a fund like this can compound over time. So let's say we start with $250. And we are going to invest in 30 years. Yes, I know this is a very long time. I'm 42. I'm telling you it's not nearly as long as you think. But if you do this and you add $250 at the beginning of every month at 14.5%, which is it's a little ambitious. I'll be honest with you. You should probably look at this at around 10%. But look at what this does over 30 years. $250 a month turns into $1.5 million, but you only contributed $90,000. This is the power of compounding that you need to understand. Compounding and the value of time produce results that don't seem like they could ever be possible. Let's lower this down to 10 just to see, this might be a little bit more reasonable, but you still have an unbelievable result. Almost $600,000 with $250 a month. And again, you only put in $90,000 of your own money. You can see this graph here at the beginning, barely anything. Your contributions and the gains are almost nothing. The green is what you put in, and the red is the interest or the compounding effect that your stocks and investments are going to have over time. You'll see that even though you still only put in $250 a month, this takes off like a rocket after some time. That's the part that people are missing. If you have the ability and the discipline to hold smaller amounts of money over time, they will do great things for you. So let's take a look at the next one, and this one is very similar, in fact almost identical. So this one is VOO, which is the Vanguard 500 Index Fund. Since this is tracking the S&P 500, just like the first one, the holdings are going to be the same. This is literally just another option from a different provider. So if we look at the holdings for VOO, we're going to find the same holdings that we found in FXAIX, again because it's tracking the same index, the S&P 500. The next one we're going to look at is FNCMX, which is Fidelity's version of the NASDAQ index. So this is going to be strikingly similar to the S&P 500 index for the top 10 companies because they're weighted on size. The size of the company is what determines how much of that portfolio is comprised of each individual holdings. So we see that we have the top 10 holdings, and those top 10 holdings make up about 59% of the total portfolio. So these 10 stocks are 59% of the total investments. So if the top 10 holdings are 59%, that tells us that there are another 2,800 companies in this portfolio that make up the other 40%. So teeny tiny slivers of your purchase are going to go into those other ones. It spreads your wealth out against a ton of companies. It helps mitigate risk. If some of those smaller companies over time end up taking off, those will eventually become bigger holdings in your portfolio. So we can see that over 10 years, this one returned on average 17.23%. So if you're a little bit younger, you might want to consider taking on, a NASDAQ index. It's a little bit more risky, but the reward can be a little bit better. You'll see here as well. Over the last year, it's returned 21.6. There must have been a slower period here because if you look at only the last 5 years, the average is 13.68. So the last couple of years have really brought this average up. So these index funds are some of the most commonly held funds out there. And again, this is what people mean when they say, I'm going to play the market or I'm going to index. Whether you're just starting out or an expert, these funds could be great additions to your portfolio. So if you think you're ready to buy these, they are available on pretty much any trading website. So you've probably heard of Fidelity like I have up on the screen. There's Charles Schwab, there's Robinhood, countless others. If you have one that's already open, just pick whatever one that you're comfortable with. They're all going to have the same features that you're going to need as a beginner to start investing. As far as the difficulty of buying goes, there is no barrier to entry. You do not need any knowledge. It's as simple as buying something on Amazon. You pull up the ticker that you like. Again, a few examples that we just went through. Click the buy button. That's it. There's really no excuse to not invest in yourself. I'm 42 now, and index funds like these have built me wealth that I never thought was possible. I'm 42, and I've been buying investments like this for over 20 years, and they've built me an amazing nest egg, an amazing peace of mind. I was actually able to leave my corporate job a few weeks ago to just explore what a year off would look like. And if I didn't have this long-term thinking and I wasn't buying things like this over decades, being able to do things like take a year off and explore other opportunities just wouldn't be possible. So if that isn't enough motivation to get you to take action going forward, I don't know what will. Invest in yourself and start now. Just like I mentioned earlier, time is the most important factor. The more time you have in the market, the better result that you're going to get. Really hope that this was helpful for you. If you could, please like or consider subscribing. I'd love to share more of my experience with you. Thanks for sharing your time with me today, and I hope to see you again. Take care.